the mitigating requires to be. So if you're looking at your max levels, you'll see where the blue line is, and you'll see how many consecutive blue lines we get with lower red lines. And if we see that, we can then mark the blue line as a sell entry price if we go back into that mitigated risk area. You know, as a great example, that NASDAQ fast money drop. Look at this fast money drop here. Right? So where is the market maker's real problems here? Well, of course, the market maker was a buyer here. Yeah, so you might argue that they were able to mitigate that risk almost, right? Almost. You can see that the market maker was a buyer here. They almost mitigated this risk, but they're only almost mitigating the risk, aren't they? They're not quite getting there. So you could argue that perhaps the market maker is now long 1, long 2, and now they're long 3, right? So when we know that, there is a massive potential that they're going to have to go heavy on a mitigation trade here. Heavy on a mitigation trade here. So as soon as the blue line goes back bid again on the way back up, there's a very good chance of a sell order opportunity. Because not necessarily because it's a short, but because the market maker is going to really have to mitigate all the risk. And that's a great place, because if they bought here and they bought here, if they bought this blue line, and they bought this blue line, and they bought that blue line, this area, gets most of that trade out for a small loss. They still make a small loss, but the half-size position from here probably makes more than enough money to cover the small loss, doesn't it? So this is an area that we would imagine is going to have a lot of risk mitigation by the market makers, and ultimately that level turns into be the top edge for that next phase to the downside.